Hello everyone, I hope you all are doing well. Thank you for having us here. My name is Prativa and today I am going to present alongside my teammates Silas and Matthew. Today we are going to walk you through Everest footwear performance review from year 11 through year 17 and laying out our strategy roadmap for what comes next. So let's get into it. So let's start with the big picture. We opened year 11 with a stock price of 48.89, and 7 years later, we closed year 17 with just $50.17, essentially flat. To put that into perspective, the industry leaders finished year 17 at $331.75, and we ranked 7 out of the 9 companies in the market. The hardest hit that come in the year 15 when our stock price dropped sharply, and despite some recovery we never got back to the competitive position ever again. That's the honest truth, and it's what drives everything else what we are going to share with you today. So let's see what went wrong. After year 13, we consistently missed our EPS target, with the worst shortfall happening in year 15. At the same time, our return of equity declined sharply after year 12 and stayed below investors' expectation. When you dig deep into the root causes, there are four things that stand out very clearly. Our margin were low compared to the industry. Our SQ rating was below average. Our market share was weak, and we were misaligned with where customer demand actually was. These were not the isolated problems. They reinforced each other throughout. A big piece of that underperformance comes down to the branding, and these three numbers will tell you the story very clearly. First, celebrity endorsement, which had 0 points. The industry average was around 105 points. Competitors logged in top celebrities years before we even entered the space, and later we simply could not close that gap. Second, our SQ rating ranged from 6.6 to 7.3 stars, while the industry average was 7.7 to 7.9 stars. So we also spent $2.5 approximately per pair on quality advertising, while the company leaders and best performers were spending $5. And third, our North America advertising spend was around 24 million, below the industry average of around $26.7 million. And we were the lowest spender in Asia Pacific region. So with all fewer retails outlet and less visibility, it's no surprise that our market kept shrinking. And branding was the compounding problem. Now I would like to hand it over to my friend Matthew to share his slides.
Hello, everyone. My name is Matthew Davis, and I will be discussing the next segment of our presentation. In this segment, we will briefly discuss our recent signs of recovery improvements and a few changes we believe we can make to propel us above our competitors. In the graphic below, you will notice that our net profit as of year 17 was $67.1 million. To put this into perspective, we had a $32.6 million net profit increase over year 15. We also currently reflect a credit rating of an A minus, which is slightly less than our investors' expectations. However, this is attributed to a recent acquisition of new production facility equipment for both our North American and our Asia Pacific facilities. Our image rating is currently an 81, and we believe that this is due to our eco and consumer positivity and also how much we spend for our superior materials and the feature and styling that we spend on each of our models of shoes. So what did we fix from year 15 to year 17 to have such a large increase in our net profit? Well, we had better production demand alignment, we improved our forecasting discipline, we increased celebrity endorsements, and we focused cost reduction in our North America and Asia Pacific plants. The next slide is going to discuss the net sales revenue and the marketing opportunities. Both of these graphics are as of year 17. As you'll see on the revenue by market, we have included the internet, the wholesale, and the private label market. And you're going to notice that Ivris was under the industry average in each of these markets. I would note that we had significant growth in year 15 and forward, and we expect that trend to continue into the future of our company. The next graphic is going to show you marketing expenses as of year 17, and you're going to note again that Ivris was under the industry average, and Ivris was actually the second lowest company to spend on marketing expenses. And we believe that an increase in ad expenditures will result in more brand recognition and an increase in sales. And I do believe that it's significant to note that Ivris is currently below the industry average in price on both the internet and wholesale markets in every region. And we believe that once we implement additional marketing expenses, that we will see an increase in our net profit because of that. The next slide is going to show you production opportunities for Ivris. So as you'll see in the production in the Europe, Africa for year 11 through year 17, there hasn't been a whole lot of movement by competitors. Latin America has seen a whole lot more competition over there, but there's really only 2 or 3 competitors that are producing large quantities. And so we believe that with the fluctuations of exchange rates and tariffs and the minimal competition in other countries, especially Europe, Africa, that we could see an opportunity for expansion. And with our price-based model, that we believe that we could be highly competitive in those areas.
Hello everyone, this is Mr. Alice Dahal. So I'm going to do further presentation in our company, Ivris. At first, we have a strategic plan year 18 to 20. So moving forward, we focus on 4 key actions to improve our performance. First, we expand production capacity in Europe, Africa, and Latin America, which helps us eliminate a tariff cost and improve margin because the cost of tariff is higher in North America. Second, we strengthen our brand by adding 3 to 4 new celebrities to increase demand and close the appeal gap, like choosing which celebrity is best in which region. Third, we improve product quality by increasing our TQM investment, which raises our SKU rating and competitiveness. And finally, we implement share buybacks and dividends to directly improve EPS and ROE. So moving on to the next slide, we have the recovery and future growth momentum. Now this recovery is not just about the past, it sets us up for future growth. We are already seeing EPS move toward our $5 target, and ROE is improving toward industry levels. At the same time, our cash position is now positive, which allows us to invest and expand further. And with the ongoing operational improvements, we expect to close the margin gap with competitors. So moving on to the last slide, we have why Ivris and why now. So why Ivris and why now? We clearly understand what went wrong and more importantly, how to fix it. We know how our company went down in market share and how our share also went down. Our strategy is specific, data-driven, and directly target the keys issue we identified. Year 15 was our lowest point, but since then we have shown consistent recovery. And because of that, we are confident in our ability to execute this turnaround and deliver sustained growth moving forward. So that's all for my presentation. Thank you very much.